India's stock market, like a roller coaster, has been on a thrilling ride. After reaching dizzying heights in late 2024, the Nifty 50, India's benchmark stock index, has taken a sharp plunge. Since October 2024, the index has plummeted by roughly 15%, leaving investors worried. This downturn reflects a confluence of negative factors, both domestic and global, that are weighing heavily on investor sentiment. The market's decline has been particularly steep in recent months, with sharp drops wiping out billions of dollars in investor wealth. The once bullish sentiment has evaporated, replaced by a sense of caution and uncertainty. The question on everyone's mind is whether this is just a temporary blip or the start of a more prolonged bear market. One of the primary drivers of the Nifty's decline has been the disappointing earnings growth reported by Indian corporates. Corporate earnings for the third quarter of fiscal year 2025 have fallen short of market expectations, painting a bleak picture of the health of the Indian economy. Many companies have cited a challenging business environment marked by rising input costs, slowing demand, and a weakening rupee. The IT and auto sectors, once considered the darlings of the Indian stock market, have been particularly hard hit, with several major players reporting significant earnings declines. This earnings slump has made investors wary, leading them to question the high valuations of many Indian stocks. Adding fuel to the fire are the ongoing trade tensions between the United States and India, China, Canada, Mexico, the EU, and virtually the rest of the world, exacerbated by the unpredictable policies of President Donald Trump. Trump's penchant for imposing tariffs has created a climate of uncertainty in global trade, hurting Indian businesses that rely on exports. The tariffs threat and counter-threats have risked the disruption of global supply chains, increased costs, and dampened global growth prospects. India, the tariff king with its large and growing economy, is particularly vulnerable to these headwinds. After China, Trump and his billionaire friend Musk may be now eyeing a big Indian consumer market with almost 350 million high middle class, equivalent to the entire US population. The trade war has also led to a flight of capital from emerging markets like India, as investors seek safe havens in developed economies. This capital outflow has put further pressure on the Indian rupee, making imports more expensive and contributing to inflation. Even before the recent downturn, concerns were brewing about the Indian market's valuation. After a multi-year rally, the Nifty 50 was trading at a price-to-earnings ratio of above 30, significantly higher than its historical fair value average of 22. This high valuation made the market susceptible to a correction, especially in light of the aforementioned challenges. At around 889 TTM EPS for Q3, FY25, and 22000 Nifty levels, the TTM PE is still around 24.75, at an expensive level compared to the average EPS growth rate of 12%. Looking ahead, Nifty EPS may grow around 9.5% CAGR for FY26-27, and in that scenario, the projected fair value of Nifty for FY26, the 27th of May, be around 22100-24200. The TTM EPS for Q3 FY25 stands around INR 889 against 837 in FY24, and at a current trend, the FY25 Nifty EPS may come to around INR 916, instead earlier market consensus of around INR 1035. The FY26 Nifty EPS may come to around INR 1004, thus considering a fair PE of 22, the current fair value of Nifty is around 19580 and the projected fair value for FY25 and FY26 should be around 20152 and 22088. At around INR 915 estimated Nifty EPS for FY25 and actual EPS INR 837 for FY24, the growth would be around 9.0%. Now assuming 9.5% average growth for FY26 and FY27, the Nifty EPS may come to around INR 1004 and INR 1099. In that scenario, assuming 22 fair PE, the projected fair value of Nifty for FY27 may be around 24200. The average growth rate of Nifty EPS is around 12% for FY 2018 to 2024 on average. Against this, the average PE is quite expensive at around 25. Now looking forward, Nifty EPS may grow around 9.5% on an average in FY 2026 to 27 amid India's economic slowdown, higher cost of living, weak labor market, that is, higher unemployment and underemployment, slowing discretionary consumer spending, and Trump tariffs tantrum. The projected FY 26-27 fair value of Nifty may be around 2,2088-24175. As the stock market is a forward discounting machine, we may assume 22000 as the Nifty bottom for the time being, unless there is more bad news, and 24200 would be the fair value target for FY 26, unless there is wide variation in Nifty earnings trajectory. And in the worst case scenario, Nifty may also further correct towards 20000-19500 in FY 26 if India's macroeconomic situation further worsens and Indian tariffs get reduced, leading to lower revenue and lower margin for domestic producers. Under lower tariffs and taxes, which is Trump seeking, Indian rich consumers may prefer cheaper or even reasonably priced US or imported goods, far superior in quality than Indian goods. In other words, Indian consumers may prefer value for money. The stock market is a slave of earnings, and all others are noise. The market generally rallies to a bubble zone on hopes and corrects on despair, and actual news and tends to fall towards true fair or intrinsic value on any excuse or big disruptive events like COVID, Trump trade war, etc. The recent earnings disappointments have only served to exacerbate these concerns. With earnings growth slowing, the justification for the Nifty's high valuation has weakened. Many analysts believe that the market needs to correct further to reflect the current economic realities and panics of the future. This means that investors may need to brace for further declines in the near term. Domestic dragons: India's internal struggles. While global factors have undoubtedly played a role in the Nifty's decline, domestic challenges have also contributed to the market's woes. India has been grappling with a multitude of legacy economic problems for decades, including higher cost of living, elevated inflation, weak labor market, and higher borrowing costs. However, Indian politicians and policymakers are not ready to even acknowledge the problem. Forget about proper solutions. Indian policymaking is all about vote banks, poor section, and note banks, super riches, while the middle class is getting the middle finger, resulting in a higher cost of living and a slowdown in discretionary consumer spending. India needs to wrest completely from political funding to social welfare funding. India needs to ensure quality universal education and healthcare policy for its huge population of almost 1.5 billion. The country needs proper policy and industrial infra to create quality jobs for millions of educated youths, rather than offering helicopter money or freebies for a certain section of the society, vote banks. India's so-called demographic dividends may be now fast turning into a demographic nightmare. Almost 90% of the younger generation now wants to leave the country, eyeing dreams of the US, UK, Canada and other developed and even developing countries for better jobs and standard of living. Lack of durable price stability has emerged as a major concern, eroding consumer purchasing power and forcing the Reserve Bank of India to maintain elevated interest rates. These higher borrowing costs are further dampening investment and economic growth. The government's efforts to boost the economy through increased spending have been slow to materialize, adding to the sense of pessimism. India's core GDP growth, that is private consumer spending and capex or private investments, remains muted, despite upbeat government spending. Indian policymakers and politicians in power always blame global headwinds rather than core domestic issues, hampering economic growth, quality employment opportunities, and price stability. Due to its huge population and relatively lower GDP output, Indian real GDP should grow around 5% annually, even in autopilot mode, for the next 25 years. But the need of the hour is at least 10% real GDP growth for the next 25 years, with a sustainable core inflation rate of around 3%, so that the Indian unemployment rate falls below 5% from the present 8% on average. RBI should be entrusted with a US Fed-like dual mandate of minimum price stability and maximum employment. Without price stability, no economy can function properly, including India. Proper price stability will also ensure sustainable employment. Global storm clouds uncertainty looms large. Beyond the Trump trade war and recession, several other geopolitical risks are clouding the global economic outlook. The ongoing conflict in Ukraine, tensions in the Middle East, and the potential for a resurgence of COVID-19-like epidemic in some parts of the world are all contributing to a climate of uncertainty. This uncertainty is making investors risk-averse, leading them to pull back from emerging markets like India. The Indian rupee, already under pressure from the trade war, has weakened further against the US dollar, adding to imported inflationary pressures. The interconnectedness of the global economy means that India cannot escape the fallout from these global challenges. Flight of the FII's foreign investors head for the exits. The Nifty's decline has been exacerbated by a massive outflow of foreign institutional investment. Foreign investors, spooked by the global and domestic headwinds facing India, have been selling their Indian holdings at a record pace. The erstwhile attraction of Modonomics is now fading due to a lack of proper economic policy reform despite growing political consolidation in the last few months. The Indian economy now needs big bang reforms from political funding to GST, tariffs, high-speed railway, industrial infra, and labor, land and energy, so that it can compete with the mighty neighbor China. India needs to encourage innovation, rather than religious polarization and Hinduism madness. This exodus of foreign capital has put further downward pressure on the Nifty. In 2024 alone, FIIs pulled out a record 2.96 trillion rupees from the Indian market, a clear indication of their waning confidence. Until foreign investors regain their appetite for Indian assets, the market is likely to remain under pressure. India's DIIs, the so-called plunge protection team, to the rescue? Domestic support offers a glimmer of hope. While FIIs and even retailers have been fleeing the Indian market, domestic institutional investors have emerged as a source of support. DIIs, which include banks, mutual funds, insurance companies, and pension funds, have been net buyers of Indian equities in recent months, helping to cushion the blow from the FII selling. This DII support reflects their belief in the long-term growth potential of the Indian economy. However, it remains to be seen whether DIIs can fully offset the selling pressure from FIIs. Nifty's outlook, a bumpy road to recovery. The outlook for the Nifty 50 remains uncertain. The index is likely to remain volatile in the near term as investors grapple with a multitude of risks, both domestic and global. The ongoing trade war, domestic economic challenges, and geopolitical tensions continue to pose significant headwinds. But some tailwinds may be also in the form of a resolution to the Trump trade war rhetoric, a pickup in government spending, RBI cutting rates faster than expected, and a revival in corporate earnings could all help to boost investor sentiment. However, for now, investors should brace for a bumpy ride till at least late March, when Trump is expected to finalize his reciprocal tariff strategy. Trump may specifically target Indian IT service exports to the US by imposing some reciprocal tariffs and regulatory blockage. Trump has threatened to impose reciprocal tariffs, meaning if India taxes US goods at a certain rate, the US will tax Indian goods at the same rate. He has criticized India's high tariffs on American products, sometimes as high as 100% or even 200%. The market is still expecting good cooperation between Trump's MAGA, Make America Great Again, and Modi's MIGA, Make India Great Again. But now the relationship between Modi and Trump is not as good as we have seen during Trump 1.0. This, along with the Adani saga in the US and recent White House humiliation and pressure tactics by Trump and Musk, India's PM Modi may be on the back foot now, while Trump is flexing muscle from tariffs to fighter jets. Modi's weakness and spineless attitude towards the ill treatment of illegal Indian immigrants show that Modi is ready to make a deal with Trump at any cost, and thus Indian tariffs on US goods may be reduced drastically, paving the way for an eventual trade deal between the US and India. Although it's not clear that Tariff King India will reduce its exorbitantly high tariffs drastically on all countries including China in the coming days. If it really happens, it would be good for the Indian consumers and economy, as domestic producers will also have to improve their efficiencies and decrease cost. The recalibration of Indian tariffs and the GST system would be a much-needed reform in India's high indirect tax. The Indian federal and state governments also have to formulate proper policy reforms in place so that domestic producers can compete with foreign producers. This may help in restoring price stability and bring down the elevated cost of living in India. Lower price stability and improved productivity are the ultimate for any economy, including India. India has to improve its productivity significantly along with lower price stability and double-digit growth to become a developed economy by the next 25 years.